Borrowing money to invest in the stock market can seem like a risky proposition. Conventional wisdom warns against accumulating debt, especially for something as unpredictable as the stock market. After all, stock prices go down just as easily as they go up. Borrowing magnifies both profits and losses. However, what if there was a way to harness the power of borrowing to potentially supercharge your investment returns? This essay explores the unconventional idea that borrowing to invest in stocks can be a wise financial strategy, but only under the right conditions. Just like a sharp knife can be a valuable tool in the hands of a skilled chef, borrowing can be a powerful tool for investors who know how to use it wisely. This essay will guide you through the nuances of borrowing to invest, examining both the risks and the rewards. Before diving into the specifics, it's crucial to establish some ground rules. Borrowing to invest is not for everyone. It requires a specific financial profile and a disciplined approach to investing. First and foremost, this strategy demands a long-term investment horizon. Short-term market fluctuations should not influence your decisions. Panic selling is the enemy of any sound investment strategy, especially when leverage is involved. Second, a high income is essential. You need to comfortably cover your loan repayments, even in years when the market is down. This strategy is not suitable for those living paycheck to paycheck. Finally, you need a solid financial foundation. This includes ample liquid assets to cover unexpected expenses and a strong credit score to secure favorable loan terms. One common method of borrowing to invest is through margin loans offered by brokerage firms. However, these loans come with significant risks, particularly for novice investors. Margin loans typically have high interest rates and can lead to margin calls, forcing you to sell investments at the worst possible time. Imagine investing with borrowed money when the market takes a sudden downturn. You receive a margin call, demanding you deposit more funds to cover your losses. Unable to meet the margin call, you're forced to sell your investments at a loss, locking in your losses, and potentially amplifying the damage. Due to the inherent risks associated with margin loans, this essay will focus on safer alternatives like term loans and lines of credit. Term loans and lines of credit offer a more stable and predictable way to borrow for investments. Term loans provide a fixed amount of money at a fixed interest rate for a set period. This predictability makes them easier to manage, especially for long-term investments. Lines of credit, on the other hand, offer flexibility. You can borrow up to a certain limit and only pay interest on the amount you actually use. This can be beneficial for investors who need access to funds, but don't want to commit to a fixed loan amount. When choosing a loan, prioritize low interest rates and avoid prepayment penalties. Ideally, opt for non-callable loans, ensuring the lender cannot demand early repayment. Section 5, The Power of Leverage, A Tale of Two Investors. To illustrate the potential benefits of borrowing to invest, let's compare two hypothetical investors, Sarah and John. Both are keen on maximizing their returns but have different strategies in mind. Both have $50,000 to invest and a long-term investment horizon. They are looking at a 10-year period to see how their investments will perform. Sarah chooses to invest her $50,000 directly in the S&P 500. She believes in the steady growth of the market and prefers a straightforward approach. John, however, decides to borrow an additional $50,000 at a 5% interest rate, investing a total of $100,000 in the S&P 500. He is willing to take on more risk for potentially higher returns. Let's assume the S&P 500 generates a 7% average annual return over the next 10 years. This is a reasonable assumption based on historical data. After 10 years, Sarah's investment would grow to approximately $98,357. This is a solid return on her initial investment. John, on the other hand, despite paying interest on his loan, would see his investment grow to approximately $196,715. His strategy of leveraging has paid off significantly. This example demonstrates how leverage can amplify returns, even after accounting for interest payments. By borrowing to invest, John was able to nearly double his returns compared to Sarah. However, it's important to remember that this is a simplified example, and actual returns can vary. Market conditions, interest rates, and individual circumstances can all impact the outcome of leveraged investments. Always consider the risks involved. Section 6. Amplifying returns, the compounding effect. The true power of borrowing to invest becomes even more apparent when considering the magic of compounding. Compounding refers to the snowball effect of earning returns on your returns. When you borrow to invest, you're essentially putting more money to work, allowing your returns to compound at a faster rate. Imagine a snowball rolling down a hill. As it rolls, it picks up more snow, growing larger and gaining momentum. Compounding works in a similar way, with your returns generating even more returns over time. The earlier you start investing and the more you invest, the greater the impact of compounding. Borrowing allows you to potentially accelerate this process, amplifying the benefits of compounding over the long term. Section 7. Beyond returns, unlocking liquidity and tax advantages. Beyond potentially boosting your investment returns, borrowing to invest can offer other advantages. First, it allows you to maintain liquidity in your personal finances. Instead of tying up all your cash in investments, you can access funds when needed without disrupting your investment strategy. Second, depending on your location and the type of loan, the interest paid on loans used for investments may be tax-deductible. Consult with a tax advisor to understand the specific rules in your jurisdiction, as tax laws can be complex and subject to change. These additional benefits, combined with the potential for amplified returns, make borrowing to invest an attractive strategy for investors who meet the criteria outlined earlier. Section 8. Risk versus reward, a calculated gamble. While borrowing to invest can be lucrative, it's crucial to acknowledge the inherent risks. The allure of potential high returns can be tempting, but one must tread carefully. The most significant risk is the potential for amplified losses. When the market takes a downturn, the impact on leveraged investments can be devastating. Just as leverage can magnify gains, it can also magnify losses. This dual-edged sword requires careful handling and a deep understanding of market dynamics. If your investments perform poorly, you could end up owing more than you initially invested. This scenario can lead to financial distress and long-term consequences. However, it's important to differentiate between perceived risk and actual risk. Understanding the nuances can help in making more informed decisions. Many people perceive borrowing to invest as extremely risky, often comparing it to gambling. This comparison, while partially valid, overlooks some critical differences. While there are similarities, a key distinction exists: control. In gambling, outcomes are left to chance with no influence from the gambler. With gambling, you have no control over the outcome. The roll of the dice or the spin of the wheel is entirely random. With investing, you have some degree of control. You can research, analyze, and choose where to allocate your funds. You choose your investments, manage your risk, and make informed decisions based on research and analysis. This proactive approach can significantly influence outcomes. Furthermore, borrowing to invest in stocks is not inherently riskier than borrowing for other assets like real estate. Both require careful consideration and strategic planning. Both involve leverage and both carry risks and rewards. The potential for profit exists, but so does the potential for loss. The key is to assess your risk tolerance, invest wisely, and borrow responsibly. By doing so, you can navigate the complexities of leveraged investing with greater confidence and control. Section 9. Conclusion: borrowing to invest, not for the faint of heart. Borrowing to invest is not a one-size-fits-all strategy. It requires a deep understanding of both the potential benefits and the inherent risks involved. It's a calculated approach that requires careful consideration, discipline, and a long-term perspective. You need to be prepared for market fluctuations and have a solid exit strategy. Before even contemplating this strategy, ensure you have a solid financial foundation, a high income, and a healthy risk appetite. This means having an emergency fund, minimal debt, and a clear understanding of your financial goals. When executed correctly, with the right financial profile and a disciplined approach, borrowing to invest can be a powerful tool for accelerating wealth creation. It can help you take advantage of market opportunities that might otherwise be out of reach. However, it's crucial to remember that leverage is a double-edged sword. The same leverage that can amplify your gains can also magnify your losses, sometimes to a devastating extent. While it can amplify gains, it can also magnify losses. This is why it's essential to have a risk management plan in place and to be prepared for the worst-case scenario. Ultimately, the decision to borrow to invest is a personal one. It should be based on your individual financial situation, risk tolerance, and investment goals. Weigh the potential rewards against the inherent risks, and if you decide to proceed, do so cautiously, strategically, and with a long-term vision. Consult with financial advisors and do thorough research before making any decisions. Remember, in the world of investing, slow and steady wins the race. Patience, diligence, and a well-thought-out plan are your best allies in achieving financial success.